Good afternoon. Today is Wednesday, February 11th, 2026. I'm Joe Terril, president of Terril and Company Private Wealth Managers in St. Louis, Missouri. And this is another video update of our thoughts on the economy, interest rates, inflation, and certainly the investment markets. With me is our investment committee, and we will get right to it. But before I do that, Brian Curtis, who produces this for me, wanted me to remind our viewers. Kristen, explain to it. What is it, Brian?
If you like our videos, like and subscribe and share.
Okay. With that said, let's talk about the economy first. As we've been saying for at least 2 years now, we believe the economy is going to stay strong. Certainly that's been the case. Recent economic figures give us no reason to change our mind. Retail sales yesterday, the headline number looked bad, but underneath it, retail sales are fine. The biggest thing was this morning's employment figures show a strong economy and no issues there. When you look around the world internationally a little bit, you see economies around the world are doing okay. So we continue to believe that things like interest rates, inflation, and et cetera, we should be dependent upon the fact that tariffs and some of the geopolitical things really doesn't seem to be having an effect on the worldwide economy. It's staying strong. But with this strong economy, Dave, you're our interest rate person. The 10-year interest rate that so many things are reflective off of a 10-year government bond, it's right back to 4.25.
It's been hanging in there at 4.15, 4.25, just sort of range bound. It sort of ticks around based upon latest economic news. If it's a little weaker, it goes down. If it's a little stronger, it goes up. But it's been very steady there. But I think what's also interesting is the market's still expecting 2 rate cuts by the Fed in the second half of this year. Total of.
But that's short-term interest rates.
Yeah,
long-term interest rates.
But with the,
for our viewers, we debate this quite a bit. You can listen to us debate it for a second. Long-term interest rates don't seem to be going down at all, and if they don't go down, what's the probability they're going to go up?
well, what that has done is created a yield curve. So
Sure.
so now banks can now make money. Banks can now make money on their investment portfolios and on their loans.
True.
And so that's, maybe that's one of the things that's supporting the economy right now. In that, but saying that, we are seeing rates globally rise. I think Australia increased their short rates today. Japan, we've talked about this before, their long-term bonds are trading at a 30-year high. And what that has done is created a global competition for capital. So now the Japanese are not buying U.S. treasuries for yield. They can buy their own treasuries and get some yield and not have to worry about currency swaps and things like that. So, and yes, as long as the economy stays firm, long-term rates are not going down. The economy hits a headwind, then we'll see rates go down.
Well, Bill, get in a moment, because I'm going to ask you to chat just a little bit, not right now, but chat just a little bit about are the markets prepared for the fact, have they built in they know they built in short-term rates going down, but whether they build in longer-term rates going down.
Yeah,
or
I don't believe they have.
Okay.
Really, when you look at market multiples.
I'm going to come back.
You bet. Yeah.
But I want to get back to something you said, Dave, which is I forget who it was, but it was somebody very notable, because I think you showed him
Yeah.
to me, is out talking about a competition for worldwide capital, that we can't all borrow billions and billions of dollars, and that's why I think viewers were correct in saying that long-term interest rate could go up. There's competition
Yeah,
for
it-
capital among various
I
countries.
think that's Bob Dallio who you're talking about, and secondarily, Jeff Dunlock is talking about emerging markets and global markets being the place to be invested, and where he's allocating more of his billions that he controls.
Kristen, I want you on camera to chat a little bit about what you asked me the other day about the budget deficit.
Sure. Well, everything I'm seeing in regards to the U.S. budget deficit, I'm concerned about that. Should I be?
Yeah, yes, I think, I think it's not only the US deficit, I think it's, global,
Especially being my age.
Yeah,
right.
I'm concerned.
Yeah.
I am.
The bills will have to be paid.
Absolutely.
And I think that was one of Bob Dallio's points in the fact that there is global competition now for capital, and that the worst case scenario, you see a bond buyer strike in the US and have a failed bond auction. Now, the market would not take that positive.
No, if we did get to that extreme, but Kristen, I think what you said and what we were talking about off camera yesterday or whenever, it is true that you must be concerned about how much money the United States is borrowing, and is there just an insatiable amount of money we're going to be able to borrow anytime we want. But what you were reading that you asked me about, when is the younger generation going to say enough is enough?
Right. Well, we're told
You're
all
gonna-
the time, we're not going to see a penny of our Social Security.
Well, you can certainly make some arguments for that type of thing, but that's a little bit more of a macro scenario. But if these long-term interest rates actually ticked up because of the budget deficit, because of the worldwide demand for capital, Bill, chat about the markets. I don't think our equity market in particular is prepared for that.
No, I don't think so. Thank you, Joe. Basically with the valuation we're seeing in the market right now, stocks are discounting a lot of things. They're excited about lower short-term rates. Earnings have been good, but there's nothing in CEO comments as we listen to companies and meet with companies that are talking about the preparation for higher long-term rates. And so the market's not prepared for it, and we think you would see a valuation re-rating as rates move higher. And with the volatility in the markets, we've seen it, in the software sector, we've seen, Bitcoin's demise impact the equity markets. Stocks react badly to things they're not prepared for. And so we continue to stay disciplined with our focus. We've done very well in some of our names like Verizon and Mosaic, 3M and Solventum. We're waiting for the Warner Brothers takeover deal to kind of work itself through. We think there's a higher bid coming. So we continue to be disciplined in our focus, and that's served us well.
Thanks, Bill, and then it leaves me a perfect way to switch to Russ. Russ, talk a little bit up, because in my opinion, and I think most of us agree, there's no question now there's a real change in the market. We've been talking about these technology stocks and how overvalued they were and how they've dominated the market. I think that's over with now. What do you think? Talk about some figures.
Yeah, thanks, Joe. I agree, and we've been on the video saying the Mag 7 glamour stocks, as Joe likes to refer them to, we thought they were overvalued. And coming into the year, you saw on our little quarterly missive, we're more cautious. And to Bill's point, we've been disciplined on our names. We're being rewarded for that, right? With the names Bill mentioned, a Mosaic and a Verizon especially. And the Mag 7 stocks are getting more volatile, right? We've seen some of the software stocks. The almighty Microsoft, for example, at one point just a couple of days ago was down almost 30% from its highs in September, October. The almighty Nvidia. So yes, we believe and have been on record as saying there's going to be a transition to the names we've been disciplined in buying, and you're seeing that. And so we continue to believe we're cautious. We are selling stocks, like we mentioned into the video, into the strength. We're continuing to maintain that buy discipline that we have, that value bias, and to Bill's point, it's serving us really well in here.
Yeah, we, let's talk about, for our viewers' sake, we continue to be a buyer of Caesars Entertainment. We continue to be a buyer of Disney, that we believe both are fundamentally undervalued, and if we are patient, we'll get rewarded on those, as we have now on our patience with the Verizon and the names that
Mosaic.
Bill mentioned.
Right.
And et cetera. But I personally think the crypto is dead now. They just haven't dug the grave yet. And the aggressive things like that, and even the constant flows into technology, it's over with. People are going to the fundamental companies that are going to be advantageous of using AI to lower their cost.
Yeah,
So-
rotation.
And keep in mind, we're not saying that they're straight down.
No,
This is
no.
this is a process.
No, but there's no question, I think our viewers should realize that this is over with now. It's not going to come back next week, and we're going to go right back to everybody chasing the same 7 high technology stocks. Buy value, buy good dividend payers, buy companies that are taking advantage of this strong economy that we started the entire video out talking about. So unless anybody has anything they want to add, thanks to everybody. Brian Curtis, thank you for helping us promote the video. And we'll be back in a couple of weeks or as needed with an update. Thank you.